Hello, 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 and a massive hello to everybody. How we all doing? Rocking and rolling in a free world. Here we go, here we go, here we go. This is 50 pips, 12th of November, 2017. No trade calls, no recommendations. Everybody's responsible for their own stuff. We're here for educational purpose only. So, as we're heading into this week, what are we looking at? Well, basically, there's not an awful lot in terms of, key data. I mean, we do have some, we have those CPIs, retail sales out of the US on Wednesday. We do have some UK data. We've got unemployment numbers out of Australia on Thursday. We got retail sales out of the UK. But, there's nothing huge in terms of data. I mean, the most interesting day with possible event risk really is Tuesday, where we've got that conference and central banker conference in Frankfurt. Well, basically we'll have Draghi speaking, Carney speaking, Karuta speaking, Yellen speaking. So there's potential for some event risk there. But apart from that, we'll be waiting to see what comes out of tax from Washington, if any Trump tweets, and again the situation with in Saudi Arabia and where things, it seems like things may be heating up, but it's definitely something you'd have to keep an eye out for. So in terms of crude, really it looks like and again it's a hard one in the sense that you can look at it technically, but all you are is some kind of lobbing a missile or something, and you're up God knows how much. So there's very little edge. I mean, structurally, if you're looking at it even on from the bigger picture on the weekly, right, it's all about that 200, right? And we talked about the fact that if anything, it looked like this is getting a little bit long in the tooth, and we'd be looking to try and trade this to the short side rather than the upside. But the problem is here with all this geopolitical risk, there's just no way we'd want to hold overnight positions, right? Or definitely not over the weekend. So we'll have to see. Technically, it looks like it's starting to look a little bit weak here. Maybe we need to see a move back into the 55, even if we're going to end up trading higher. So I think really here, just technically, 55's a tracked. That would be the healthy move, both for the bulls and the bears, and then that's where the market will decide if it wants to take a stab at those 65s or resume the downtrend. So it's a key level, but the problem is all your headline away to silly move. So it's very tricky to tricky to trade, especially with overnight positions. So what's going on in the markets? In terms of markets, and it's fairly similar action across the board. If you see the ES, it looks like we're struggling a little bit at these highs, right? And if anything, it looks like the market is set up for some kind of correction. I mean, to the upside, where could we go? You've always got the chance that we need to clear some weak players above that 2600, just the psychological level. But unless we get something major in terms of positive news out of Washington or something, it's hard to see why we should aggressively rally above that 2600. So here it looks like we may be shaping up for a little bit of a correction, and we could even have a 8% correction, 10% correction all the way back into these 24s, and it's still holding the uptrend. But if anything, it looks like it's struggling more and more, and that's something which is fairly apparent across the board. If you look at the DAX, let's see if this is going to load. We discussed this on the DAX. This is very heavy action. As we said, we were posting this on Twitter saying, there's not much edge as long as we're hovering around in the golden circle, but we break outside, whether it's to the upside or the downside, then we should get a sustained move. We broke to the downside, so even there, right, broke down, fill the gap, and it's holding very heavy. So as long as we can't regain these highs here, you'd expect this to have a little bit more follow through to the downside. And, you'd be looking at the very least for the market to try and come back into this confluence of these previous highs in the 50 on the daily. And this is something which is fairly, you can see that across the board. Even if you look at the FTSE not looking too hot here. Fairly a big test, right? Because you've got a confluence of all these moving averages, the 50, the 100, and the 200. So if anything, this is, even if it pukes a little bit lower, this is a place where you should see some kind of a healthy bounce. Whether that's just to smack them back down or to resume the uptrend, it doesn't matter. But the point is here, it looks like it'll likely continue, but it would be healthy to see some kind of bounce. So we definitely wouldn't want to be shorting this into the hole here unless you get some very ugly news. Now, should we trade below this level on the weekly, then it gets very, very ugly. And the other one, which is probably the most important, and we discussed this week, was basically the Nikkei. And basically you saw this huge exhaustion at highs on a very, very big range day. Highest volume we had since of the year, clearly. So this is very ugly. So the question is really, apart from as we say, apart from the BOJ, it's very hard to imagine who's going to want to come in, wake up any morning in Tokyo and say, I really got to get myself some of this this Nikkei here, buy this into this high. So we suspect you continue to see selling as we press back into those highs. Here, the healthy move, you could see anyway all the way back down. You see how extended this is, how much room it has to go. So this is clearly the one to watch, because especially if we continue to see such aggressive action, if it's orderly, it's different. But if this is not orderly and you start to see this puke in the overnight sessions, it's going to be very hard for all the other indices to not follow. Okay, and even before the Nikkei, really, the tell, what we'd been looking at and what we'd been discussing for a while was basically the junk bonds, right? J and K. You see how aggressive how aggressive this move has been, right? Once we started to fail here, said watch out here, because if it starts to get below these, you've got situations where the moving, again, we're not huge moving average traders, but we like them just to explain what's going on. But when you get situations when the moving averages are flattening out, right, it's just a period of rest for the market, but it's really gathering energy, right? So usually what it does, the longer it hovers around in these in this sideways kind of patterns, the more it's building up energy, and the breaks can be very, very aggressive, especially if you get a little bit of follow through. Usually they got legs, right? So here you see how we broke down. So again, this is another one like the Nikkei. It's very hard to see how anybody's going to want to aggressively buy this. Now clearly, if we break back above, then you'd expect this to accelerate to take out those highs very aggressively. But unless it trades back above there, you really have to look at this as sell any kind of rally for a move back lower, and at least to try and take out these lows, right? Look at the volume also, right? These are very, very interesting moves. And you can look at it on the ZBs too. We're getting a lot of questions on the ZBs, and what we've been saying, it's a really hard read because it's hovering inside this range, and it's much to do about nothing as long as it stays inside the range. But the velocity of the move has been aggressive, and as we've been saying, don't get confused with these drive-by shootings, low liquidity chop. You're seeing funky moves on some of the indices. You're getting funky moves on the metals, both to the upside and the downside. It's just the market is a little bit off, and it really feels like something's got to give and something is brewing. And you've seen some hints of that this week, where all the charts started to move in sync. We'll have to see how this happens, but clearly both to the upside here, when we moved, right, you got 1, 2, 3, 4, 5, 6, 7, 8, pretty much 9 positive days in a row after a false break, but an aggressive move to the downside, and then bam, we puke right back down. So does this mean we're going lower? Well, not more than this meant that we were going higher, right? We're still stuck inside this range. So really, we're going to keep on maintaining that unless we get a real sustained break outside these highs or these lows here, right? And what do we mean there? We need to get like weekly closes outside, right? Then we could look for the next move. As long as we're staying inside here, it's very, 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 very choppy. But again, it looks like, as we said, it's very hard to imagine. If you've seen this, a lot of people call it, the everything bubble, whatever you want to call, but this whole move with equities higher and bonds higher. If this is going to unwind with any gusto, there's very little doubt in our mind that ultimately the way it's going to unwind is stocks down, bonds down. That's the only way it can really unwind. Even though you get some funky action here and there, ultimately, if we get a big unwind, we'd see it as stocks down, bonds down. That's the way we've been playing it. That's the way we've been looking at it. Now, the other thing a lot of people are looking at is the dollar, and it does look like it's having a little bit of trouble. This is another one where we could easily make the case both to the bull side or the bear side. Here it does look like it's struggling, right? Similar to a lot of the other charts. So what we would say is below 94 40s, heavy, above bullish for the 95.80s. Essentially what's happening here, as we've discussed, we're still stuck inside, right, these moving averages, right? You're going to have, on any aggressive move up, you've got the 200 capping to the downside, and on any puke, you're going to have the 50 and the 100 acting as support. So this is the kind of situation, if you're looking at it on the broader picture, well, yes, there are going to be plenty of ways to trade this to the long side and to the short side. But what we like to remind people is don't get too enamored with your position, or don't think the picture is that clear, because most likely, unless you get closes above the 200 or below these moving averages, the picture is going to remain very, very choppy, right? Below these two, then very likely we get a run back to test those lows. Back above, we'd expect to see a retest of that breakdown point. But right here, it's very, very tricky, right? The market is still looking for direction. The market is still looking for a catalyst, right? Be careful when it looks too obvious. And it's the same way we've been discussing on Euro, right? Said, here's the box. The only way to look at this is bullish above, bearish below. The daily close below there, we'd expect, unless it can regain, you would expect it technically to try and come back down and print into the 1290s, right? But it's just hasn't been getting any traction, right? And as we said the other day, we talked about it on Twitter as the nicest asymmetric play on the board was to get long Euro. Is, no matter how bearish it looked on the bigger picture, you've got to listen and look to what price is saying, right? It couldn't break lower. So here, whether we're going lower or not long term, the tightest asymmetric play was, on this false break, is to get back long, stops below these lows, looking for it to come back to the opposite side of the range. Now, does that mean we're going higher? Does that mean we're going lower? We don't know yet, but all you do know is that when the market is going in a sideways, nothing's happening, and it fails to test one side to get Momo on a break, most likely it's going to come back into mid or try and test the opposite side. And again, here in terms of the daily, it's still interesting, because the guys who probably bought that move lower looking for a false break, even in terms of bigger picture, there's no way they're going to give up their longs until we trade below here on a daily close. And the shorts that have been short since the highs or the break are, there's no real reason to cut those, because you could argue as long as you don't take this out, it's still okay. As long as you don't take out these moving averages, it's still okay. As long as you don't take this out, it's still okay. So what it makes for a lot of potential velocity of move inside range here, which doesn't necessarily mean anything. So you could see a lot of volatility here, and because most likely the bigger players, nobody's got stops inside this range. There'll probably be a lot of retail playing inside this range. So again, interesting, and that ties into what we discussed with on yen, where we expected, again, for us, the asymmetric play was to get short on that failure to trade, to hold above the 1450s for a move back into 112. And essentially that trade is also still in play, right? So as long as we don't trade back above the 114, we still think the path least resistance is back into more neutral territory at 112. And then we'll see which way we'll go. But, not a lot has happened. Not a lot has happened, but in terms of the charts really breaking out of the broader ranges. But what has happened is that basically you're seeing that as aggressive move on J and K. You've started to see that range expansion at high on the Nikkei. You've started to see that aggressive weakness coming in on the DAX. You've seen that weakness coming in on the FTSE, right? So it does look like the market may be trying to get a little bit of Momo to see that healthy correction on the equities. You have seen VIX spiking a little bit, and the favorite sport in town, whack-a-mole, hasn't managed to play out because we didn't close the week back below 10. Surprise, surprise, we're above here. So we may be shaping up for something interesting, or at least fingers crossed for interesting action in November. So let's see what happens. Thank you so much for listening. Thank you so much for sharing. Thank you for all the likes. As usual, hit me up on Twitter if you have any questions or any comments, and I'll try and post some more of these charts throughout the week. Have an awesome one. Take care. Bye-bye, guys.